What is up, everybody? Matthew Decker here, Leveraged Wealth. This is the first YouTube Live that we've really ever done, and we decided to do it because we get a bunch of questions on a weekly basis, and we just thought it would be fun to answer some questions live and make it a little bit more interactive, and then also kind of show you the process that we go through when it comes to an Index Universal Life policy review. So we're going to be starting off with a live policy review. Before we get started though, I do just want to real quickly just make sure that everybody can hear me. You can put that in the chats. So yeah, just let me know if you can hear me, but I assume that you can. We've tested it and everything looked good. We'll be here for about 45 minutes, or at least as long as it takes to kind of get through some of the questions that we got. So we actually sent out an email to our distribution database and just said, hey, we're going to be answering some questions. And what questions would you like for us to kind of tackle on life insurance or annuities or financial planning? And so we've got some questions here that we'll kind of go through at the end, and then I'll be looking at the chats as well. If we get any questions in the chat here live, we'll try to tackle those as well. And if we don't get to all the questions today, we'll probably do another one of these. So with all that being said, what I'd like to do is just kind of tell you a little bit about kind of who we are, why we decided to do this YouTube channel and kind of what we're all about. And so we started this YouTube channel probably like 4 to 5 years ago, and it's been under a couple different names. But the reason we started doing it is because my partner and I were basically wholesalers in this financial insurance services industry. And we were doing financial plans and estate planning for independent advisors all across the country. And what we continually saw was, the plans that we would kind of put in front of the independent advisors that we were working for and working with, they hardly ever got, enacted or put in place the way that we recommended them to be put in place. And the number one question that we would always get from our independent agents that we worked with was, how much is this going to make me? How much commission is this going to make me? And that really rubbed us the wrong way. And because of some of those experiences, we decided to, we could do this better. We could actually serve clients better than the way that they're being served from, most of the advisors that we knew at the time. And since then, we've met some amazing advisors. So I don't want to paint the picture that everybody out there is bad, but that was our experience. That was our lived real life experience. I toughed that out for about 3 years. My partner did for about 5. We quit. We started our own brand. So we have a local financial planning practice, and then we do a ton of estate planning and policy reviews all across the country through this Leveraged Wealth brand. And we really started it based on education, based on doing things the right way, and making sure that clients that got policies, they knew what they were getting, number one. They weren't being oversold, number two. And that it was just being done the right way, that it was being done in a transparent way. And throughout that process, we actually just tallied up all these numbers 2 or 3 days ago, not really in preparation for really this video or anything that we're doing, but just because we decided to kind of look at it. How many policy reviews do we do in a year? We tallied it up. We do about 500 policy reviews every single year, which is insane. Those aren't current clients. Those are 500 policy reviews of people who send us their policy and want us to take a look at it because they've got questions. And throughout that process, 500 policy reviews a year, we've saved over $40 million in lifetime fees and excess premiums. $40 million out of those 500 reviews per year. And that's not all 500 people making any changes to the policies. Those are just the ones that we found that we could improve upon. $40 million in fees and excess premiums we've saved. And we've added an additional $60 million in lifetime income distributions just by doing things the right way, minimizing fees, minimizing commissions, maximizing cash growth, and getting people into a product that actually has good long-term contractual provisions. So again, Matt Decker here, Leveraged Wealth Management. We're doing this YouTube Live. We're going to start with the policy review, and then I'm also going to be answering questions. So if you have questions about life insurance, about annuities, about financial planning, you can throw those in the chat, and we'll get to them as kind of we get through this live policy review. Because I want you guys to see, number one, kind of the set of criteria that we look at when we do policy reviews, how that kind of shakes out, and how we compare that on the back end to what else is available. And then I do want to get to your questions if you have them. So throw those in the comments, and make sure that if you can't hear me, let me know in the chat as well, and we can kind of check that out. But you should be able to hear me nice and loud. So let's get to this policy review and kind of show you what we do on pretty much a daily basis. 500 policy reviews a year, and this is pretty typical. So I'm going to share my screen, and we're going to go through this just kind of one step at a time here. So this is a Transamerica policy, and this is pretty typical of Transamerica policies. Now we've changed everything. We actually reran this policy, so it was sent into us. Somebody else had proposed it, and we reran it exactly as it was, just to kind of protect the innocent and to protect the guilty. Now I'm not the guilty. My name's there because, again, we reran it. But let's just kind of go through this one at a time. We'll start with just Transamerica. Right off the bat, whenever I see a Transamerica policy, my initial reaction is this is probably a policy that is being positioned by a multi-level marketing agent, a multi-level marketing general agency. What that means for you, Transamerica does a lot of business in this kind of multi-level marketing, financial services. Let me build my team, buy one of these policies, get your license, join my team, get all your friends to buy policies. And if you get 5 friends to buy policies, your policy's free. I mean, that's kind of how this is done. And if you are in this industry as an agent, you know that this goes on, and it's probably the most abused area in the industry. And I don't want to necessarily name companies, although I have named them before on the channel. But the biggest problem here is when you're more concerned about building a team and building a downline, you are less concerned about the client that you're serving. And so because of that, we see a lot of part-time agents selling really bad policies. And so when I see Transamerica, that's the first thing that I think, oh no, here comes another part-time agent. This is going to be sold at maximum commission, maximum death benefit, and it's going to be a poor design. But let's just reserve judgment until we get into this. So the first thing that we're going to look at when we do a policy review, besides who it's with, the company, is going to be, let me share my screen again, is going to be, number one, what is the death benefit to premium ratio? And so right here we can see it's a 45-year-old male preferred plus, and they're paying just under $40,000 a year, and they've got a $2.5 million death benefit, which kind of, after doing thousands of these, I know that that's probably too much death benefit relative to the premium that's being paid if the goal is maximum cash and income. I know that that's pretty much where this is already headed. And I actually haven't looked at this yet. I had Brady in our office. I said, hey, send me kind of a recent policy that we're set to review. And so this is what we got. The second thing I'm going to look at is what's the death benefit option, and it's actually getting worse. So this is a CVAT graded death benefit option with Transamerica. And now I know for sure, if I had any suspicion that the death benefit to premium ratio was out of whack, the $2.5 million in face amount versus the $40,000 in premium, if I had any suspicions that those things were out of whack, now it's confirmed because it's paired with this CVAT death benefit. And so without going any further, and again, I haven't looked at this, but I know what it's going to show me, I can almost guarantee you that the cash value is going to be $0 in the first year. It might be $0 maybe up to 3 years, but it's definitely going to be $0 in cash value in year 1. It's probably going to be $0 in cash value in year 2, maybe even in year 3. The worst I've seen, it goes out 4 years. 4 years of $0 in cash surrender value, which it doesn't take too much intellect to look at that policy and say, how's this in my best interest? I have $0 in cash surrender value for the first 3 to 4 years. So I know right out of the gate that that's where this is headed. But I do want to just spend a little bit of time here and talk about a couple things with Transamerica. Transamerica is a tough company to do reviews on because of two main reasons. The first reason being, I believe they are the only company that has this index account monthly charge. So this is an additional charge. It's not necessarily an asset-based fee, but it is a charge that's going to show up every single month. And the purpose of this charge is going to be to keep the caps high, which I suppose is fine, but it makes this policy pretty expensive. So that's the first thing that you have to know about Transamerica. This index account monthly charge keeps it pretty high, keeps the expenses pretty high. The second thing you have to know is that almost every single Transamerica policy that's been sold in the last, let's call it 10 years, is using their global index account. And their global index account is the one with a relatively high cap, but almost all the returns are being supported by the Hang Seng index and some big blowout years that the Hang Seng has had over the last 10 to 15 years. So when you look at their historical numbers, that index is being kind of artificially inflated by some blowout years in the Hang Seng index. And so that's neither here nor there. That's kind of a throwaway comment. You just have to know that about Transamerica. The back-tested returns are not necessarily what you might think that they are, and it's really being supported by some huge returns in one particular index. And will that continue? That's hard to say. But the first weird thing about Transamerica is going to be this index account monthly charge. Hey, Christopher, thanks for throwing something in the chat there. I've got your question here on MPI. That's a great question. We'll get to that. Thank you. The second thing about Transamerica is going to be when it comes to their loans. So if you're doing an index universal life insurance policy and you want the maximum potential for income, you're going to want a participating loan option. Now that doesn't mean that you're going to use it, but you're going to want the option to use it. And so Transamerica doesn't have that. What they have is just a fixed loan, or like a wash loan option, as it's commonly referred to. So if you are looking for a policy that's going to have the highest potential tax-free income, it's not going to be any policy that doesn't give you a participating loan value. And Transamerica doesn't do that. Hey, Dale, same question on MPI. Got it. Thank you. So those are the two main issues with Transamerica that I have in this policy in particular, aside from just the fact that I know it's going to be a bad design. So let's just go ahead and get to the cash, because at this point, nothing else really matters. So here we are. We got 100% of the premium in the global account. We're showing a 7% return. Again, a refresher on our premium, $40,000 in annual premium, $39,600. That's being paid for life, which is another reason I know that this is structured poorly, because if that's being paid for life and it's paired with this CVAT policy, then it's not going to be designed for max income. I just know that. And so let's check out our cash values. So $39,600 going in, $2.5 million in death benefit, and there it is. This is exactly what I'm talking about. So we got 2 years of zero cash surrender value right out of the gate, which is a pretty much, full stop, telltale sign that this is not designed as well as it could be. But that's fine. Let's just go ahead and continue. What I really want to do, and I'm going to show us some additional options here, even with Transamerica. Let's look at year 25 cash value. So you've paid that $40,000 in for 25 years. Your death benefit has risen all those years. You're up to $4.1 million in death benefit. But again, the goal of this policy, and this is stated by the client who sent this in, hey, I'm looking for max cash, max accumulation, maximum potential income. So if that's the goal, you don't want $4.1 million in death benefit. You don't want $2.5 million in death benefit. You want the IRS minimum amount. And still have everything coming out tax-free. That's the goal. And so we've got $1.6 million in cash here in year 25. So let's just stop right there. What I'd really like to do is just show you how we can improve upon this. So we reran this Transamerica policy and we structured it for maximum cash and income. We ran it at the same 7% return, but you can see we dropped the death benefit all the way down to $675,000. And we're using an increasing death benefit option instead of that CVAT design, which is going to be much more efficient for lifetime premiums. It's going to be much more efficient for cash growth and income if you did want to use this Transamerica policy for income, which I wouldn't necessarily recommend out of the gate. But that's okay. So we've got, again, 100% of the premium in that global account. We've optimized this with the right death benefit option, the minimum face amount relative to the premium that's being paid. It's the same person, 45 preferred plus. And when we go to year one, we have $19,000 in cash surrender value. So $19,000 in cash surrender value year one versus $0 in cash surrender value year one, the way it was originally sent to us. The policy value, so the amount of money earning interest, $28,592. The policy value in year one on our design, $37,117. I mean, this is worlds better if the goal is maximum cash and income. It's so much better that if the client did want $2.5 million in death benefit, we could easily reduce this $40,000 premium and we could buy a term policy for the difference between these two figures and still be well ahead than just putting everything into this poorly structured Transamerica policy. Year two, we've got $58,000 in cash versus zero. I mean, it doesn't, again, this is an easy one. The unfortunate thing is, this is extremely typical. This is a very typical policy design that we would see almost anytime we see a Transamerica policy, almost anytime we see a nationwide policy. Most of the time when we see a Pacific Life policy, it's not as bad as this, but it's close. And that's just how it is. Those three companies, they do a lot of work with that multi-level marketing part-time agency force. And this is what ends up getting kind of sent to clients is not this one, but this poorly designed policies that are more structured for commission versus cash accumulation, which is just too bad. It keeps us busy, but you know, there are a lot of clients that buy these policies and that's too bad. If you've got questions, put them in the chat. We'll get to as many of the questions as we can. We're going through a live policy review here, and then we'll try to answer any questions that you do have in the chat. So throw those in there, and we'll get to them after we're done with our policy review. Thanks to Dale and Chris who already put those in there. So in our policy design, let's go out to year, was it 25? The bad one. Yeah, year 25, age 70, we were looking at $1.6 million in cash. And so that's kind of the bogey that we're trying to beat. So we go back to this Transamerica design that we did with the right kind of parameters, the right set of death benefit relative to premium, the right death benefit type. We go out to year 25, we're at 2.1 million in cash. 2.1 million in cash versus 1.6 million in cash. I mean, this is a huge material difference. If I had to guess, I would say that in the second design, the commission is about 60% less, but the client ends up with an additional almost $500,000 of cash in 25 years, which is just, I mean, anybody who's doing it the other way, they're just doing it the wrong way. Now, I also have to be careful. I got to be really careful because this can get me pretty heated. Again, this keeps us in business. This keeps us reviewing poor policies. And, you know, we take a lot of clients and put them in better positions because of these types of designs. But I have to say, there's a lot of clients. Of those 500 reviews that we did, you know, that $40 million in premium saved and the $60 million in additional income generated, those are only with the clients that actually decided to do something with us. There's a huge percentage of those 500 reviews a year where they already have this policy. They are 2 or 3 years into it. And if you're 2 years in to this policy and you've got a $0 cash surrender value, what are your options? You don't have any good options. You've got $0. You can't move it. You could cancel it and just say, well, that was my tuition money to learn how to do this the right way. That's a tough spot. So I got to be really careful because my knee-jerk reaction is to say that the agents who are selling these policies know exactly what they're doing. That's my knee-jerk reaction. And I think that there are some that fall into that category. I think there's a larger number of agents selling these policies that are selling them this way because they don't know any better. And, that's not an excuse for them. They need to get educated so that they can know better. But I don't think it's malicious. I think that they are involved in, general agencies, or they're involved in multi-level marketing programs, and they just simply don't know any better. And this is what comes out as a result. Or, they meet with the client. The client tells them what their budget is, and they're not even running the illustrations. They send it to their IMO, which is a marketing organization for insurance agents that essentially runs quotes if you don't know how to do it. So they outsource the work to somebody else, and that person is running it this way because maybe they get a cut of the business. There's all kinds of reasons why you could end up with a poor policy like this. But the upshot is, does it matter what the reasons are if clients are losing out on $500,000 in cash over 20 years or 25 years? What was the number? 25 years, $500,000 in additional cash over 25 years. Does it matter why it was done wrong? To the client, it doesn't. The client doesn't care why it was done wrong. They just know that they have less money. And so, this is a huge problem, and this is why we've really started this channel. And again, I'll say, we want your questions. So throw some questions in the comments if you've got them, and we'll get to them after this policy review. Nothing's off the table, except maybe personal questions. I don't know. I guess it depends on what I get. So anyway, that's the Transamerica policy if it was redone. Okay, if it was redone the right way, 2.1 million in cash versus 1.6 million in cash in year 25. This is a no-brainer. This is a layup. This is a fast break layup in terms of a better policy. However, stopping here would really be stopping short of doing what's right. Because again, this is still that Transamerica policy. It does have that index account monthly charge. It does have most of its growth supported by the Hang Seng Index with no diversification away from the S&P, and it doesn't have any participating loan options. So if you want the ability to leverage income and you want kind of the highest potential income and you're willing to take a little bit more risk, you can't do it with Transamerica. So we reran these exact same parameters with two different companies just to kind of show you where Transamerica falls on this. So the first one we ran with F&G. And really, I had Brady in our office run these quotes, and I just said, hey, just pick two companies. It doesn't matter what they are, because I know that pretty much any company Brady picks is going to be better than Transamerica. And that was the only direction that I gave him. Match the premium, design it the right way, pick two companies. So we've got the same premium going in, $39.6. We've got basically the same, optimized death benefit, $659. We're using a lower illustrated rate, so 6.48%. So we're already behind the eight ball, the Transamerica policy, and we're comparing it to the one we did. So 2.1 million in cash was the one that we optimized with Transamerica. This was at the 7% rate of return. So 7% rate of return every single year in the optimized Transamerica policy got us to 2.1 million in cash year 25. In our F&G policy, we're running it at 6.48, not 7%. Same premium going in, optimized design. We go out to year 25, age 70, and we're at $2.38 million in cash. Okay, so this is why I say anytime I see a Transamerica policy, I pretty much know that whoever is showing that Transamerica policy is either not an independent agent, they're a semi-captive GA type agent, they're a part-time agent, or they're in one of these multi-level marketing kind of hierarchy type outfits, because anybody that knows how to run their own quotes is at least going to run two or three, and Transamerica is not going to give you the most cash unless you're illustrating at like an 8% rate of return, which I don't think they allow you to do anymore. So 2.38 million in cash in the F&G policy over the same 25 years with the same premium going in, using a lower rate of return, 6.48 versus 7, and we're generating an additional $200,000 in cash in year 25. It's crazy stuff. Let's look at AIG, which is the other company that Brady decided to run, and it's the same 6.48%, so less than the 7 that Transamerica was showing. We've optimized it for cash growth and income. You'll notice that even our cash value, this is actually probably a useful comparison as well that we didn't even talk about. So F&G has a little bit higher cash surrender values in the first couple of years, 22 and 58. The Transamerica redone was close to that, though. I mean, it wasn't that far off, 19,058. So by year 2, the cash values between F&G and Transamerica are pretty much the same. What's the difference? The difference is that indexed account monthly charge that's on that Transamerica policy that really doesn't exist anywhere else. And after 25 years of that, it gets expensive and it starts to eat into the cash. Even using a higher rate of return, it can't keep pace. And the AIG is similar. So 16,000 year one, which is less, 56 in year two. But I think it's probably going to catch up by year 25. Let's check. So 25, 2.32 million in cash in year 25. $2.9 million death benefit. And again, this is at a 6.48% rate of return. So a client comes to us, they send us a policy, they say, hey, is this any good? And we see Transamerica, we see that death benefit, we see that it's a level graded death benefit option, CVAT, and unfortunately we have to say, no, it's not any good. It's a poorly designed policy. It was designed for maximum commissions. It was not designed for maximum cash growth. It doesn't even have the right policy provisions for what you would want if your goal was maximum cash and income. And we have to show some better options. And these are two better options. And this is just one example. I mean, we're talking about an additional $500,000 in cash in year 25 on one policy. Is it any wonder that we've generated an additional $60 million in lifetime income by doing policy reviews? Because you see policies that are done so poorly with the wrong companies that it's easy to put clients in a much, much, much better position. All right, so that's our policy review. And we might be releasing more info. If you're an independent insurance agent out there and you want to know kind of like how we do what we do, we might be kind of opening up a mastermind group. We'll see. It depends on what kind of response we get. But I should add, if you want a review of your policy, here's what you need to do. You need to go to our website, leveragewm.com/IUL-review. It takes you to this webpage, and it's essentially going to ask you a couple questions. Is a policy review right for you? You take this real short quiz. I think it's like 5 to 6 questions. I have an existing policy and I want it reviewed. I want the maximum tax-free income. Yes, I want your help. And then it basically spits you out to a calendar appointment and you can book a call with us right here. So anyway, if you want a policy review, that's where you need to go. leveragewm.com/IUL-review. All right, let's get to some questions. Hey, Jason, thanks for the chat. Is there a safe distribution rate for IUL once the client goes into retirement? That is a great question. We will definitely answer that question. I want to talk about MPI real quick first, though. Let me just revise my screen here. All right, so MPI. What's my opinion on the MPI strategy? Do you believe caps will continue to decrease over the next 5 to 10 years? All right, let's tackle the second half of that question first. Do I believe caps will continue to decrease over the next 5 to 10 years? It depends. So caps, if you're working with a good company, let me pull up an illustration just to help us. Actually, we can use one of the ones we just looked at. If you're working with a good company, caps should be revenue neutral. Okay, so caps and the setting of caps, if you're working with an A-rated company that is in this for the long haul, they should be revenue neutral. There's a couple companies, I'm just looking here for what I want out of this AIG policy to kind of illustrate what I'm talking about. There's a couple companies that try to make money on the setting of their caps. I wouldn't recommend that. They're not going to give me what I want. But all the good ones, here we go. All the good ones are going to be revenue neutral. So this is the F&G policy that we just looked at. And all I wanted was just their crediting rate chart. So when it comes to caps, great question, Chris. Every single year, the company is coming to the client, and what they're ultimately going to say, they're going to send out the annual statement. You'll get that in the mail. It'll tell you what you paid in fees. It'll tell you what your cash has grown to. It'll tell you your performance for the previous year. And then it'll give you a selection of how you want to invest going forward into the next year. And really what they're asking you is, do you want the fixed rate? That's what they're asking you. Do you want the fixed rate for the next year? And in this F&G policy, the fixed rate is 4.75%. Okay, great. It's probably tough to see because it's orange there, but it's 4.75% is the fixed rate. So good companies who are doing things the right way, who are revenue neutral on their caps, what they're going to do is they're going to say, hey, if you want the fixed rate, take it. It's yours, 4.75%. If you don't want the fixed rate, we're going to spend the same amount of dollars. It's the same 4.75% that we're already on the hook to pay you. But instead of just giving it to you in the form of the fixed rate, we're going to invest in one of these hedges. You tell us which hedge you want, or tell us which combination of hedges you want. So this feels like maybe a roundabout answer to your question about caps decreasing over the next 5 years. The thing that's going to control caps, the two things, more than anything. Number one, volatility. So let's talk about the S&P, which one would be good? The S&P 1 year with 100% par rate. Let's just go with this top one. It's blue, so that's nice. So it's got a 12.5% cap, which I think might be the highest S&P cap in the industry on a 1 year point-to-point with 100% participation rate right now. But that's beside the point. So the thing that's going to drive the cap rate, one of the things the most, is going to be volatility. The S&P option is typically going to be the most volatile option that exists on all these different contracts. And so it should have the lowest cap. And especially if you compared it to like a volatility control index, or if you compared it to like a blended index, which, Securian has a blended index, AIG has a blended index, Allianz has a blended index. A lot of them do. Those are always a higher cap than the S&P. Why? Well, because those blended index options typically have bond components. Bond component brings the volatility of the index down, which makes it cheaper to hedge. And since the company is spending the exact same amount of dollars, no matter which index you choose, it's the 4.75% that they were already on the hook to pay you. Since they're spending the same dollars on all these different index options, they're all going to have different caps. And the caps are going to be driven by the volatility of the index. So that's the first thing that could drive caps down. If volatility spikes and option pricing increases, caps will decrease. And that's just a market-driven function. It exists in every single hedging function, even outside of life insurance. If you tried to buy an at-the-money option on the S&P when the VIX is at 80, it's going to be more expensive than when the VIX is at 12. That's just market pricing. That's the Black-Scholes model. That's just how it works. So caps will come down if volatility spikes. That's the first thing. The second thing is caps will come down as fixed rates come down. Because again, if all of a sudden F&G doesn't have a 4.75% fixed rate, if all of a sudden they have a 3.75% fixed rate, that means the money that they have to spend on the option is not 4.75, it's 3.75, which means they can buy, or they can't buy, the same cap that they could have if they had a larger budget. What drives the fixed rates? The thing that drives the fixed rates is just the interest rate market in general. This is a long answer to this question, but I hope that you're finding it valuable. So what drives the fixed rate? It's their underlying bond portfolio that they're typically holding to maturity. So they have 10, 20, 30-year maturities of bonds that they hold. They average all those together and they come up with their portfolio rate. And most companies pass along their portfolio rate in the form of their fixed rate on the contracts. And so caps will come down if volatility spikes, and the opposite is also true. If volatility drops, caps have an opportunity to go up. And caps will come down if the portfolio rate, the underlying investments on some of these insurance companies, drops. Then they will have a smaller options budget, which means they will have less money to spend on the hedge, which means they won't be able to buy the same high cap. And so those are the main things that will drop caps. Since we are in a low interest rate environment, I do expect caps to maybe drop or stay level. If interest rates stay where they are now, we can probably get away without having to drop caps much further. But if interest rates drop back down again, then ultimately, yes, caps will come down a little bit. The good news is, we were in a low interest rate environment for a pretty significant chunk of time, and caps are going to lag behind interest rates in life products by a couple years. In annuity products, you see it immediately, which is why annuity products are always changing. They're repriced as soon as there's a change in interest rates. Life insurance policies are different because they have flow premium versus single premium. So An annuity policy changes its caps as soon as interest rates move because they're taking one-time premiums. You want an annuity, you've got $300,000, you put it in one time and that's it. So they have to price those products based on today's rates. Insurance policies are typically like this one, $40,000 a year for 20 or 30 years. So they have 20 or 30 years of premiums to basically kind of level out the interest rate risk. That's a really technical answer to your relatively simple question. I expect that caps will kind of stay level if interest rates stay where they are for the next 5 to 10 years. If interest rates continue to rise a little bit, I expect caps to go back up. The main caveat to that question is volatility. If you get volatility spikes, your S&P caps will come down. Great question. To the MPI strategy. What's my opinion on the MPI strategy? In theory, the MPI strategy is not much different than traditional premium finance. And I don't really want to talk about premium finance on this live because it's probably too complicated to do in a question and answer format, but I've done a bunch of videos on premium finance that you can check out. But conceptually, it's pretty much the same. My biggest gripe with the MPI strategy is that it's typically oversold and you're essentially leveraging up the policy to the maximum amount as soon as possible. And so the way that I've seen the MPI strategy is like you pay 3, 4, or 5 years of premium, let's call it $50,000 a year. And then at some point in time, you switch over to taking $50,000 loans from the policy and then paying that loan back into the policy as premium. And the reason you would do that is because your accumulation value is unaffected by a participating loan. You pay that back in as premium dollars, your accumulation value goes up, your loan balance goes up, and you're basically just living on the spread between those two things. I think that it can work, but I think that it typically will not work if you're leveraging it up as much as you can. So my general rule of thumb is you need a little bit more skin in the game in order to make that strategy work. My bigger issue is the best companies that you would want to do MPI with do not allow it. And so that's my biggest issue. My biggest issue is I don't want to do MPI, premium financing leveraging, with Mutual of Omaha. I don't want to do it with Mutual of Omaha. I want to do it with a company that actually knows what they're doing, that's committed to this space, that has a history of caps that I can see, that has good long-term contractual provisions, that's revenue neutral on their caps, that has a good cash reserve and good guarantees. And I don't see any companies that allow the MPI strategy that make it through our filter of things that we look for contractually in a good long-term policy. And that's my biggest gripe. Because you can always artificially dial back the leverage, but what you can't do is change contractual provisions inside a policy once you've purchased it. So that's my biggest issue with the MPI strategy. I got another question. Again, we're taking questions. So if you have questions, throw them into the chat and we'll try to get to them if we can. We're going to go for maybe another 20, 30 minutes. It depends on how many questions we do get. But I've got a couple other things. We got an email question that I thought was great. And it took me a lot of work, but I think we ended up in a pretty good spot and I think it'll be valuable. So we'll go through that. So the question was this. I'll read it to you because I want to get it right. I want to give credit where credit is due. So let's just give credit where credit is due. So Barry reached out to me, and Barry is in the industry, I believe. He's a CRPC. So he reached out to me and he said, hey, Matt, here's my question. On IUL illustrations, the guaranteed interest with guaranteed charges is shown, which we know. The guaranteed column shows guaranteed interest, guaranteed charges. That usually will result in an early policy lapse, of course. What I want to see is the non-guaranteed assumed interest rate with the maximum charges. So what he's saying is, and he says he can't get that from any other carrier, he's asked and nobody has shown it to him. And so let me just paraphrase that or rephrase it. What he's asking for is there a way to show like a 6% rate of return on these index life policies on top of maximum policy charges, which companies don't show that. And I think that's a good question. So what I had to do was essentially recreate a spreadsheet, and it took some doing. And if you've ever sat in front of Excel and tried to solve logic problems for 7 or 8 hours, it's not the funnest thing to do. But I think we ended up in a good spot. So I ran a policy. It's in Excel because it has to be. If it's not in Excel, I couldn't get the data to work because I had to kind of reverse engineer everything. So it's a $30,000 premium for 15 years. We minimize the death benefit. It's $460. I don't even know if you can see that. I'll try to make it bigger. Here we go. So $30,000 a year, premium, $434,000 in death benefit. This is a 45-year-old. I don't remember the rate class, preferred or standard. I guess it doesn't really matter. And this is the current charges and the current assumed rate. I believe we used 6.6, somewhere in there. And so we go out, 25 years down the road, we've got 1.1 million in cash, 1.185 million in cash, $1.3 million in death benefit. And so what I had to basically do, because the company doesn't readily give up their guaranteed rates. And so I should probably explain a little bit about how we had to do this. So the first thing we had to do was essentially pull out all the guaranteed charges on the policy. And the biggest thing with the guaranteed charges is your premium load on most policies is not going to drop off or go away on the guaranteed column. So that's the first thing. So you can see here we go from 24, maybe you can't see, let me make it bigger. We go from 2,400 in premium load to 1,200 in premium load in year 10. We know that on the guaranteed charges column, that doesn't happen. It stays at 2,400, so we kept it at 2,400. The second thing is most policies on the guaranteed charge, this per unit charge is not going to go away. So we extend out the per unit charge for the life of the policy. And then the last thing would just be cost of insurance. Now, cost of insurance is the variable that's really difficult to account for because it's not fixed. And so we just had to kind of reverse engineer the math, which we did. And then the other thing is we have to do a corridor calculation to make sure that our cash value doesn't ever eclipse the death benefit and kind of get the right ratio needed for corridor at every single age. So anyway, I did all that. I reverse engineered everything and I got pretty darn close. It's not perfect, but it's probably within $1,000 or so. And so when I do that, we've got maximum charges at a 6.5% current rate. So maximum charges allowed contractually with a 6.5% rate of return based on this $30,000 premium and the $400-some thousand in death benefit. And let's check year 15. So in year 15, we got $621,000 in accumulation value. The current in year 15 was 636. So 636 versus 621. So it's $15,000 less in cash value based on the guaranteed charges at the current rate. And if we go down, and I should add, the reason that it's actually not as much as you might think is because as your charges increase, the corridor shrinks faster, is I guess the easiest way to explain that. And so if the corridor shrinks faster, you actually don't have to pay as much on the COIs if you are at guaranteed charges, even though the guaranteed charges are higher. And we do have the guaranteed COI charges in here. Let's look at year 25. So year 25, we have 1.12 million in cash on the guarantees at the current rate. Under the max charges, year 25, we were about 1.185. So 1.185 versus 1.12. So $65,000 less in cash at maximum charges and current rates, which I think is actually a really good story to tell. Can companies increase charges? Yes, absolutely they can. Do many of them do that? No, I think only 3 of them have done that. And 1 of them or 2 of them were B-rated at the time. Transamerica, Baltimore Life, F&G has done it on a block of business that they purchased, but But no big A-rated reputable carriers have increased their COI charges, and even if they did increase them to the contractual maximum, if you still earn that same rate of return, you're talking about a difference of, let's just call it $60,000 to $80,000 on this particular policy, which is a $30,000 15 pay. So I'm not going to send this to anybody because it was a difficult task to do. And if you change one of the cells, it's going to mess up all the formulas. So I'm not going to send it to anybody, but I thought it was an interesting exercise. We've got guaranteed charges at the current interest rate, 25 years down the road, let's call it $80,000 less in cash, but it's still got an internal rate of return probably somewhere in the 6% range, which is phenomenal for a fixed product that can't go backwards and can be utilized tax-free as non-reportable income. So that was a question from Barry. Thank you, Barry. Put your questions in the chat if you have additional questions. We'll go for about 15 more minutes. We'll try to answer as many as we can. The goal here is to just spend some time asking some questions that you guys may have for us. So we got some others through email that I want to go through. What is the minimum amount to put into a cash value life insurance policy to make it worth it for supplemental retirement income? We get this question all the time. They added, I'm guessing $100 a month is likely not enough to move the needle. And I would say, yeah, if you're serious about using this for cash growth and income, we primarily position this to high income earners, people that are close to, if not eclipsing, that Roth IRA threshold to be able to contribute to a Roth IRA, or those that have already maxed out a Roth IRA. That's kind of where we see this as a really good fit. So is $100 a month enough? No, I would say it's not enough. I would say bare bones minimum, you probably don't want to do this, unless you're at the $500 to $600 a month. Most of our policies are $1,000 plus a month. And the reason being is, the one risk to these policies that kind of goes untalked about is really liquidity risk, your own personal liquidity. Can you follow through with the payment plan that you've kind of set out for yourself? And if you can follow through with the payment plan, you can ride out some storms, and this policy is going to work for you long term. If you can't stick to the payment plan that you put in place, then this policy is not going to perform the way that you want it to, and it's probably not going to be an asset that you're happy with long term. But it's not the policy's fault. It's the follow-through risk that's really the issue. And so, if someone comes to us and says, hey, I can do $200 a month, I immediately am going to question the viability of that $200 a month. And so we would say, $500 to $600 is probably the minimum, but really we'd like to see $1,000, just because we know that person is a little bit more serious about these policies. They probably have the cash flow to support it. And once you get up to that $1,000 a month mark, you've probably already funded a Roth IRA, or maybe you're over the threshold of contributing to a Roth IRA. And that's where these policies make a ton of sense. How do we define high earners was another question that we got. And again, it's basically what we just said. People who are getting close to eclipsing that Roth IRA phase out limit. Let's see here. This is a good one. Suppose I leave the U.S. permanently after 5 years of a policy. Can I still continue my indexed universal life insurance policy? And the answer is absolutely you can. However, there are some issues that you need to be aware of. So the biggest issue is if you leave the country and you have an IUL policy, you just have to know that, number one, that premium is always going to have to be paid from a U.S. bank account. That's the first thing. The second thing is if you're going to utilize that for income of any kind, the cash also has to come out and be paid to a U.S. bank account. Now, what you do with it from there is totally up to you. But if you are going to permanently leave the country, you just have to understand that that money is still here in the States. They're not going to send you an ACH to a bank account in India or in Canada or in Mexico. It's going to have to be sent to a US-based bank account. So can you have one? Absolutely. Can you continue it? Absolutely. Is it going to change the way that it works? Absolutely not. Will it change the way you use it? It might, because if you don't have, you're going to have to keep a US bank account open. And if you want to get that money overseas, then that's a whole different question. And you're getting into like international kind of tax issues there. But you can have one. It is unaffected. You just have to keep a US bank account. What happens to the cash savings when the person dies? So that's a really good question. Let's pull up another illustration here. We'll just go back to the F&G because I've got it handy. We get this question all the time, and it's typically posed by people who sell whole life. They say, you know, the company keeps your cash, they give you your death benefit, but they keep the cash. Well, not necessarily. Not necessarily true. So you actually get the choice. If you want your cash and your death benefit, you do have that as an option. It's totally up to you. That's called an increasing death benefit. And so you can actually see that happening right here. This policy starts at $659,471. And every single year, the cash value is added to the death benefit. That's why it's $692 in year one. $692 in year one because you take that $33,522 and you add it to the $659 and you get $692. So in this example, the death benefit is including the cash in the death benefit. It's literally just thrown over on top of the death benefit. However, that is going to make the policy more expensive long term. So we don't see people elect that increasing death benefit typically for life. What we typically see is an increasing death benefit during the premium paying years. And then once premium is done being paid, we elect to not have cash value added to death benefit, because the way that these fees are determined is on a really simple calculation. It's called your net amount at risk. So you take your death benefit, you subtract out your cash value. The difference between those two figures is the amount of money that is kind of tied to your cost of insurance charge. So your cost of insurance factor is multiplied across the net amount at risk, death benefit minus cash value. Well, if every single year you're simply adding your cash value to your death benefit, that means your net amount at risk is always going to be the $659,471 in this example. It'll never change. And since these policies do increase in fees every single year, you're having a larger multiple multiplied across the same $659,471 every single year, which makes the policy more expensive the longer you go. So you have that option if you want it. And we've seen it used. You know, you get 20 years down the road, someone's unhealthy. We planned on using this for cash and income, but they're unhealthy. We keep that increasing death benefit on there and just tack it onto their death benefit, turn it into a death benefit vehicle. But most people are going to drop the increasing death benefit, which is going to shrink your net amount at risk. And so a lot of times what we'll see is, you know, once you drop that increasing death benefit when you're ready to start taking income, your net amount at risk is no longer $659,000. It might be $150,000 or $200,000. Which means, has your cost of insurance factor gone up? Yes, it has, but now it's being multiplied across a smaller number, a smaller net amount at risk, which actually reduces your fees. And so if your goal is maximum cash and income, then that's what you would want to do. You wouldn't want your cash added to your death benefit, because then you're going to be paying fees associated with the full $659 net amount at risk in all years. And that's going to be multiplied across a factor that's increasing. If the idea is cash growth, you want the opposite. You want to be multiplying that cost of insurance factor that is increasing across a continually smaller number. You want the net amount at risk to shrink. You want to get your death benefit and your cash value as close as possible so that your fees are as small as possible. That's what's going to increase your income and make these policies a really efficient tax-free income generator. Chris asked me a question and then he said I answered it. When you design, do you change to level death benefit when you enter retirement so the fee? Yes. Yes, we do. I think there was another question here. Jason asked, Matt, always enjoy your content. Thank you, Jason. Do you think that there is a safe distribution rate for IUL once the client gets into retirement? I think I said originally that was a great question. It is a great question. Let's end on this question because we've been going for almost an hour. I'm going to share an additional illustration here just so that we can, because I don't think any of these have income projections. So let me pick another one. But I got to pick a good one. It's too big. This one will work. All right. So, and I suppose I should probably put it over here. there is a distribution rate. I don't want to call it a safe distribution rate, but there is a distribution rate that that makes sense. No, let me take that back. Distribution rate is difficult because it depends on how the policy performs, right? We know for a fact that you're not going to get a 6% rate of return or a 7% rate of return or whatever the number is. It doesn't matter. You're not going to get that every single year on the nose. You might average it, but you're going to get it with zeros. You're going to get it with years that cap out. You're going to get it with everything in between. So that poses this distribution rate issue. That makes that a difficult question to answer, but I think I do have an answer for you that's maybe a little bit more helpful. So what I like to do is, this is a $100,000 policy for 10 years, minimum death benefit design, and the goal is maximum income here in 19 years. This is an Allianz policy. It doesn't matter the policy, but we're working off this 192. This is what matters. So this $192,000 is the maximum amount that can be loaned out at a 6% rate of return for life. That's what this 192 represents. The maximum mathematical amount based on all the charges and all the fees that can be loaned out of this policy for life, tax-free, without lapsing the contract if you earn a 6% rate of return. Since we know that we're not going to earn a 6% rate of return every single year, and since we know, and if you don't, you have to pay the fees. So in year 16, the fees are $2,600, which means your account value is going to go back by $2,600 if you get a 0%. Okay, so that's kind of the issue that we're talking about here. So instead of thinking about a distribution rate, I mean, this is close to like, what, 8%? Instead of thinking about a distribution rate, what I'd rather do is give a window of possible outcomes. And I think the easiest way to communicate this to a client is just to say, hey, look, we're projecting $192,000 per year of income, but the reality is that depends on returns. And we don't know what those returns are going to be. You don't know what they're going to be. I don't know what they're going to be. Nobody knows what they're going to be. So let's just say that you're going to be within a 20% window up or down. It could be 20% lower. It could be 20% higher. It just depends on what happens in the stock market. It depends on your sequence of returns. And it just generally depends on performance on the policy and what caps do, what does volatility look like, what do interest rates look like. And I think that's the easiest way to give a really good projection, is to say, here's the theoretical maximum based on some 6% rate of return or 6.5, whatever number you want to use. And then just give yourself a window, 20% less, could be 20% less, could be 20% more, but it's going to be somewhere within that window, and we can say that with a relatively high degree of confidence. That's how I'd answer that question. I wouldn't answer it with a distribution rate, because the minute you answer it with a distribution rate, that rate is going to be stuck in that client's mind, and they're going to think, I can take 8% per year. And more than likely, with a lot of agents who are maybe older and getting ready to retire, they tell a client it's an 8% safe withdrawal rate, and they retire, and 30 years down the road, the client's just thinking 8%, 8%, 8% without actually reviewing and looking at the policy. So make it a window, which implies that there's going to be they're going to need to be flexible based on performance, and that just kind of preconditions them to look at this more often. But great question. Tenzin plays 3. Thanks for your question. How's the company make money in the index even though the money is not in the market? How does the company make money in the index? Thank you for your question. The company does not make money in the index. The hedge is revenue neutral to pretty much every good index life company. So the company does not make money in the hedge. If you're asking, how does the policyholder make money in the index, even though the money is not in the market? That's a question I can answer. So the way that they're doing that is by buying option spreads. So they're buying a call spread on the S&P, which starts at 0 and can go as high as, let's just say, 12.5. And there is no return above 12.5. Like, nobody's capturing. If the S&P does 20 and your cap is 12.5, there is no additional 7.5%. It's gone. It doesn't exist. because they've purchased a call spread, which essentially a call spread says, here's an at-the-money call option, which means you have the right to purchase this security at this price for 1 year. And so if all of a sudden the price of that security, if it starts here, if the price of that security falls below your purchase price, you're just out the money that they fronted you, which goes back to what we originally talked about, that 4.75% fixed rate. That's the money they were already promising to pay you. That's the money that gets invested in the index. It's not your dollars. It's the company's 4.75 or 4% fixed rate. They're fronting you the dollars. They're buying the hedge and at the money call spread. So if it starts at the money and it falls below, you don't get the 4.75%. The 4.75% is gone. You purchased a spread. The spread was not profitable. There is no return that year. Let's say that the spread is, and so that 4.75%, they buy a call option, but they can't just simply buy a naked call option. One call option is considered a naked call option. They don't have enough money to buy a naked call option. So what they have to do is they have to sell a call option at some increase in price. Let's call it 12.5% above the spot price, above the at-the-money price. They have to sell a call option here in order to offset the price of this first call option to make it fit within their 4.75% budget. And so if the return shoots past the call option that they've sold, there is no return past the call option. The call options here that they've sold, there is no return past the call option. It doesn't exist. It can't exist because your window of returns is fixed between the at-the-money price and the option that was sold to offset the initial price of the first option. So when you get into some of these volatility controlled index options that have no cap, the reason it has no cap is because it is a naked option. They do not have to sell an additional call option above the current price to offset the cost of that spread. They just simply buy a naked option. And the fact in some of them, they're able to buy like 1.6 options naked for every client holder. So that's how you get 160% participation rate. You get 1.6 naked call options. That's 160% participation rate. So I hope that makes sense. That's a pretty technical answer to a relatively simple question. The companies don't make money in the index. It's revenue neutral. There is no return above the cap. It doesn't exist. The company is fronting you the money for the hedge. If the hedge pays, you capture all the profit of the hedge. If the hedge doesn't pay, you simply don't get your fixed rate for that year. You don't get any index rate for that year. So hopefully that was helpful. I'll just reiterate, if you are looking at index life policies, if you're unsure whether this is a right fit for you or not, I'd encourage you to go to our website, leveragewm.com/ you can go to contact-us, or you can go to that IUL-review webpage. I'll put it here in the chat just so that you know what it is. leveragewm.com/IUL-review. That is going to take you to the quiz. Let's do this right. https://www. That's the secure one. You can go there. You can take the IUL quiz. It's just an easy way for us to kind of get an understanding of what you're looking to do. Do you already have a policy? Do you not have a policy? Do you want our help? You can go there. You can book a meeting with us. And then also, keep questions coming. We'll probably do more of these kind of YouTube lives, go through a policy, answer some questions. But again, thanks so much for hanging out with me. It's been really fun for me. Time has flown, but I'm going to head out here. Thanks so much for your time, and we'll see you next time.